Next, we'll talk about what do we do with these discounts and premiums. They have to influence our accounting record somehow. So there are two ways to do it. One is the amortization method, and the other is the effective interest method. You read about both of them. We're going to focus primarily on the amortization method, but we'll talk a little bit about the effective interest rate. So in problem 5, it says we have 5-year 9% bonds with a face value of $100,000. They're issued at 95 on January 1st, 2019. Now you may have thought as you were reading the book and as I was reading this problem that this must be a typo. Issued at 95? That seems like something's missing. But that's really how we say it. What it means is it was issued at 95%, or 0.95. So we sold $100,000 bonds at 95% of their value, which means the carrying value would be 100,000 times 0.95, or 95,000. Now let's think, would this be issued at a premium or a discount? If you sell someone $100,000 bonds for $95,000, did they pay a premium or get a discount? That's right, it's a discount. So now we want to calculate the premium or the discount. To do that, we start with face value. And then we subtract face value times issue, 0.95, and we get $5,000. So let's talk about what the journal entry would look like. We've decided to issue these bonds. We sold them at a discount. So we received cash of $95,000. Our investors paid $95,000 for the bonds. Skip a line, and then our credit is bonds payable. That's for $100,000, because even if we sell the bonds, if we issue them at a discount or a premium, we still, at the end of the life of the bonds, when the bonds mature, will pay $100,000. So how do I make this balance? I have $95,000 in debits and $100,000 in credits. So I'm missing a $5,000 debit. That's a discount on bonds of $5,000. So this is a 5-year bond. This is year 1 in the beginning. And at the end of each year, we're going to make an interest payment to these bondholders. And then at the end of the 5th year, we'll pay back the bond. So what would our journal entry be for interest expense at the end of the 1st year? What would it be? Well, first we need to figure out what is our interest expense. And when you have a discount or a premium, that affects your interest expense. So first we want to calculate our interest. Our stated interest, if you go to the top of the problem, is 9% a year. Well, 9% of $100,000 is $9,000. But then we also need to amortize our discount, and that will affect our interest. We have a $5,000 discount, and that $5,000 over 5 years is $1,000 per year. So we'll need to include $1,000 of that amortized discount in our interest expense each year for the next 5 years. But would that increase interest expense or decrease it? Did that discount on the bond that was issued represent additional cost for the company or additional income for the company? Let's think about that. The bondholders gave the company $95,000, and the company promised to pay the bondholders $100,000 plus interest later. So issuing it for $95,000 was a cost. That was an increase in the expense of the bond. So we will add our discount, so our total interest expense is $10,000. So we would say interest expense for $10,000, cash of $9,000, because that's what we agreed in the bond to pay annually. And then we will credit discount on bond for $1,000. Notice that this discount on bonds was debited when we first issued the bonds, and now it's credited when we amortize the interest. So how would this entry be different for the end of the next 4 years? There would be no difference. It's the same interest and amortized discount each year. And then when the bond is over, we would say, okay, end of the 5 years, time for us to pay this back. So we know we're going to pay cash of $100,000. We've already paid all the interest, so we're not worried about interest. And we're paying off the liability, so we'll debit it for $100,000. So now we've seen the entry we make at the beginning, the entry we make 5 times throughout the life of the bonds, and the entry we make when the bonds are repaid on their maturity. Now at the beginning of this video, we talked about how there are 2 ways to deal with the discounts and premiums. One, which we just did, is the amortization method. The other is the effective interest method. The effective interest method gets a little more complicated with the math and uses things like time value of money, which you haven't learned yet. So, you'll learn more about the effective interest method as you take advanced accounting classes, because I know all of you want to be accountants. That's it for how we handle a discount. The next video will look at the same process, but for a premium.